Hey guys, I'm Thomas Delello, head trader and founder at orderflowedge.com. I want to welcome everyone to the Thanksgiving Trade-A-Thon here today. I'm super excited to have the opportunity to kick things off this morning. I want to thank everyone from TradingPub, Yana and Raleigh, and everyone for inviting us to join the festivities here. So this morning we're going to be discussing order flow and how we use the order flow info to trade in the markets. It's not so much of a trading system in the classic sense of the phrase. It's much more a way of understanding the markets by using logical order flow tools and concepts, and then turning around and being able to use that awareness to identify when and where opportunity is present in the market. Opportunity that offers us ideal risk-reward situations where we have probabilities on our side. And at the end of the day, the idea is to learn to see trading for what it is, and at its very core, it's nothing but pieces of information, all ones and zeros. Everything is reducible to information and architecture components, the framework that ultimately you use to organize and read the information that the market's giving you. And there isn't a single thing about trading that is magical or mystical or, out of the reach of logical analysis and awareness. And the good news is it can all be broken down, this information, every single piece. Understand the pieces, the parts, and then you begin to understand the whole. And that's the way that we teach. I like to teach in terms of concepts. You understand concepts one by one, and then you learn how they work together to form that synergy that you're looking for. It's about being able to make sense of the market so ultimately you can trust your own decisions. Because let's face it, the thing that you as a trader really must learn to trust if you want to succeed is yourself, trusting your own ability to make decisions, right? Do you trust the process that you use to make those decisions? It's knowing something is true because it makes logical sense and you've seen it work because you've observed it yourself. That's the state where you want to get yourself to. So we're going to be breaking things down today in a logical manner and making things as simple as we can to understand. And basically the way that we've automated the order flow information, what we've built and what we use every day in our own trading, it's a framework that in effect shines a light on the important information that we should be paying attention to. Right? It shows us what the smart money is doing in the market very specifically. So we have a better chance to emulate that. We want to trade in the direction that they're trading in. We want to trade in the areas they're trading in, and we have real-time clues in the order flow that confirm their activity for us. Basics. It's easy to understand the logic behind it. It makes it simple to follow the stop runs that are taking place in the market. So I'm looking forward to the opportunity of sharing my market perspective and some order flow theories. And in the process, hopefully today I can encourage you to think in some new directions about the market and about the order flow that's actually driving price action. I'm here to help you guys today, so if you have any questions, you have an hour of my undivided attention here. Any questions you have about order flow, supply and demand, please ask. And what I'll do is answer some of them as I go, but I usually wind up catching up with most of them towards the end. And here's the thing, guys. On the screen, you see a link there. If what we talk about here today, and understand that we're just going to be scraping the surface here today. I just want to lay a good foundation of understanding for you. But I don't want to throw too much information at you. I don't want it to be like you're trying to drink from a fire hose, all right? I want to lay a little bit of a foundation, but if what we talk about here today resonates with you, we're going to be holding an open trade room tomorrow morning, and I'd like to invite everyone to join us, and that'll give us the opportunity to go into things a little bit deeper, and we won't have any time restriction. And for you to see us in action real time with live charts tomorrow, where we'll scope out some trades and kind of talk about things real time as things are setting up. So you got the link there in the screen. I think Yana just put it in. Or just email support@orderflowedge.com and request the invite, and we'll be sure to get you the link for tomorrow. Now, I'm going to show you the types of conditions and patterns that we look for that represent opportunity in the market and in turn set up high probability trade entries. More importantly, I'm going to teach you what some of these patterns mean, the dynamics occurring beneath the surface that actually cause these conditions and patterns to play out the way that they do. It's kind of like lifting the hood to look underneath at the engine and see exactly what's driving price. Order flow, right? So we're going to talk about order flow, obviously. We're going to talk a lot about the smart money. You can't win going against the smart money, plain and simple. So it's critical that you gain an understanding of how they operate in the market and where they operate in the market. So we're going to talk a lot about that. When we're talking about When we say smart money, the consistently successful traders in the market, right? What's their secret? How do they do it? They understand market structure. That's how. They understand how the market functions. They know where value is in the market, and they use this information to their advantage, right? We're talking about the bots, the algos, the smart money traders. They all chase your stops. They know where and how retail traders and retail trading systems apply stops in the market, and they know exactly how to take advantage of this. Professionals know how to exploit the weakness of other traders continually over and over every single day, and that's what they do. You can learn how to identify that manipulation. You could see, as we see every day, how the smart money manipulates the structure of the market to their benefit, how they exploit the weakness of other traders, and you'll also begin to see how that could lead you to where the opportunity is in the markets. So yeah, it's definitely a different perspective on what drives price. Right? Our edge is based ultimately on understanding that order flow is what drives price. Most traders are looking at price as the cause of price, and I think that's where they find difficulty in identifying any sort of real edge in the market. Right? Whereas I look at price as the result, the after effect of order flow. Let me give you a little bit of an analogy on that. Right? As a trader, first off, you have to focus on the reality of the market, right, and how the market operates rather than on your perception or reality of what you think the market is operating on, right, or what you find appealing. And most people find looking at price appealing. Right? It seems easy. They're looking at price or some derivative of price to get some sort of clue on where price is headed next or how much longer price is going to continue to run in the same direction. Let me give you an analogy on that. That's kind of like looking at your car engine and trying to determine how much longer your engine is going to run. You don't do that, right? You look at your fuel gauge to see how much gas you have left to power the engine. In effect, it's the same thing that we're doing with order flow. We use the order flow info to give us clues on what price is likely to do next, right? Price is motivated by trade, not by price itself, right? So we're looking at the order flow to pick up on clues in what's happening in price, right? So let's start with some basics here. What we say order flow, what we're referring to are the buyers and sellers coming into the market. Right? Simply put, it's the real-time supply and demand caused by all the buyers and sellers coming into the market. The buy orders and the sell orders that turn into trades is what we're tracking. Right? It's that flow of orders coming into the market that actually causes price to move. So ultimately, we're crunching the order flow data to find value and opportunity before everyone else sees it, essentially. Right? We're looking for imbalances in the pressure between the buying and the selling, particularly when those imbalances are occurring against levels of supply above the market or levels of demand below the market. Right? So essentially, we boil trading down to a few fairly simple concepts based on the order flow information that the market's giving us. Supremely, we're thinking who's in control, buyers or sellers, and when is that control shifting? Right? We're watching for important clues in the information that we follow, components that are going to set up every time that we take a trade. Right? We're looking for stop run exhaustion, which will occur into smart money participation, which in turn will trap traders, and these trap traders in turn create new stop runs in the opposite direction, right? Where they have to exit their losing trades. Right? And we're going to get into that a little bit deeper. I'm going to give you a couple illustrations on that. But when it comes down to it, guys, we make it logical. And when you think in logical terms, you can't help but make things simple to understand. Right? And on a very basic level, we want to be aware of three basic things in the market. Right? Which direction the smart money trader is more aggressive in, right? To the buy side or the sell side. And that's the direction that we want to trade in, right? That's going to be our bias. Number two, we want to be able to identify ideal trade location, right? Trade location meaning inflection points in the market where we expect the smart money to be active, right? Where the important retail supply areas and wholesale demand levels are above and below the market. And when the market gets into these areas, who's in control, buyers or sellers, right? That's number three, the clues that are showing us who's actually in control real time and when is that control shifting. Right? Because let's face it, we want to trade in the direction whoever is in control. Who's doing a better job of moving the market, right? And at the end of the day, it's understanding and trading the markets in a way that will give you back your decision-making powers and enable you to compete in the markets alongside the smart money at their own game. And I understand, guys, that if this is the first time you're hearing someone talk about the markets in these terms, it could take a little getting used to. It's a new perspective, but one that's very logical and uncomplicated because I think one of the main issues for most traders is people tend to turn the trading process into a real complicated, really unnecessarily complicated process because they're looking for perfection, right? They're looking for the holy grail, something that's going to give them zero losing trades. And by doing that, what happens is along the way, and I've been there, now I'm speaking from experience, by doing that along the way, what you do is wind up collecting and piling on indicators and systems and opinions from different people, and things get real noisy. And it shouldn't be that way. It doesn't have to be complicated. As long as you're looking at the right information, the order flow data that actually drives price, and you have an effective way to organize and analyze that data on your screen, right? A framework that processes that data for you, right? So let's move along here a bit now. Why do we follow the order flow, right? Well, first and foremost, order flow drives price. Change in order flow precedes change in price. And it helps us to identify potential reactions in price, we call them RIPs, before they occur. And when it comes down to it, listen, trading in the market's always going to be a business of incomplete information, but nothing gives us the degree of transparency that order flow does. And when you're tracking the order flow, you can see the buying and selling that's actually causing price to move. And as you begin to see that on an everyday basis, you also begin to understand and identify where the opportunity is in the market, right? We employ strategies based on order imbalance driven price reversals. Think about it. If we know that order flow is the fuel that drives price, then it makes logical sense that we would want to pay attention to what the order flow is doing, right? Because order flow drives price. So we're looking for clues that show up in the order flow before they show up in price. We're looking for exhaustion in the order flow to occur before price makes a move or reverses direction. So we're gonna go through as much as we can here today. Again, I don't want to throw too much information at you, but we're gonna cover the 3 steps that we use to identify opportunity. We're gonna talk a bit about stop runs and trap traders. Initially, that's going to be the foundation that we're going to lay. And then we're going to look at the actual order flow tools that we've built, the tools that take the order flow data that the market is giving us about the buying and selling that's coming into the market. And these tools process this information for us, the order flow information, and they create alerts and signals on a regular chart so that we get the benefits of the order flow information without the noise and the concentration often required if you were having to follow the order flow tick by tick. Right? So the other main reason why we follow the order flow is the smart money follows the order flow. Right? HFTs, algos, trading programs, they all follow the order flow. Very important because we want to be doing what they're doing, right? As closely as we can, we want to emulate them. Now, this is from a study, and I've read, maybe one day I'll write one, but I've read many white papers on HFTs and their relation to order flow. And if anybody wants links, don't hesitate to send us an email, myself or Casey, and we'll send you links for a couple of really interesting papers on the market. One of these papers that was done at Harvard, I think 2 years ago, he stated that, he followed what the biggest HFTs in the markets were doing. And he found that their strategies are consistent with strategies based on order imbalance driven price reversals, right? So, I mean, we knew it to begin with, but that's pretty good proof right there that the smart money are using order flow as well. So we're on the right track. Right? Consistently profitable traders equals smart money, right? And we're talking about smart money traders again, so everybody's on the same page here. Because we speak a lot about the smart money, and here's the thing, you're going to find it to be a very tough road ahead going against the smart money, plain and simple. Right? If they're buying, you want to be buying. At the very least, you don't want to be selling against them. You don't want to be going up against them. Right? Here's the thing, every time you get into a trade, there's always someone on the other side of that trade. And you don't want that someone to be a consistently winning trader. You want the person who just took the other side of your trade to be a consistently losing trader. Right? So if they're selling, you have to do what you can to be a seller and at least not be buying against them. Right? So we're talking about individuals, we're talking about market makers, we're talking about floor traders, and we talk about smart money, banks and institutions, commercial entities, HFT firms, computerized trading programs. These are all traders that are lumped into that category of smart money traders. As long as you're consistently profitable, I don't care if you're sitting at home in your underwear trading 2 lots, 5 lots. If you're consistently profitable, you're a smart money trader. Right? Now, order flow data, the basic ideas of order flow, supply and demand, and the smart money running stops have been around forever. Right? And even though the markets have evolved, obviously, with technology through the years, the same basic market structure still exists. The basic ideas, I should say, of order flow and supply and demand. Wyckoff, Livermore in the early 1900s all spoke of the smart money and the composite operator and how they accumulated inventory at lows and they would push the market up. They hit buy stops so they could distribute, they could sell into those buy stops at higher prices. They sell their longs, they get into shorts, and they take it right around the other way and do the same thing all over again at lows. And it's the same concept today, only it's the algos and the HFTs who are doing the majority of the stop running, right? Because they really develop most of the volume in most of the markets that are trading these days, right? But these HFTs and algos, they're the ones that are locking onto the stops and pushing the market hard one way. Hitting the stops, they take it right back the other direction. They lock onto the stops. They know where the stops are. Once they lock on, it's a foregone conclusion that they're going to run them. The computers, they figured it out, guys. They know when everyone gets too long in a certain spot or too short. The programs feel out market depth with exploratory orders. They read the same information that we do. Right? And once these algos lock onto the stops, it's a done deal. Right? And that's why we look to trade with the algos, not against them. And I don't see, this whole algo thing as a negative, this whole HFT thing. Everyone complains about the HFTs, but I like seeing them on the stops because I know that opportunity is setting up when they do. And that's what they do. They feed on the stop. So when we see them, it's kind of a flag going up showing us that there's going to be opportunity. And if it's not there right then and there, it's going to be there soon. So how do we join the HFTs and the algos? By programming our own algos. A major influence on me, the thing that I realized that once the HFTs came on the scene was that in order to compete in this HFT-dominated environment, I needed to automate as much as this order flow information that I was following that I could in order to be able to make quicker decisions, right? So it's the same information that I'm following, with these tools that we've built. It's just that the computer's doing more of the heavy lifting for me. It's doing more of the work for me. So I don't have to analyze as much stuff. I understand everything that it's doing, but it's making things simpler for me. It's making me focus on the important information and getting rid of the noise, right? So I did this by programming our own algos that automatically take the order flow data and translate it into readable, highly usable information that alerts us to opportunity. What it's doing basically is determining several different things for us based on the order flow data that's being analyzed, right? We're talking about our bias. It's telling us what direction we should be looking to trade in, right? It's giving us ideal trade location, which is very important. Again, ideal trade location to me, and we'll talk a little bit more about this, but ideal trade location, there's really two main factors that classify ideal trade location, right? Number one, areas where we assume the smart money is going to be looking to trade, right? Because we want to trade where they're trading. And also an area where I don't have to take too much risk to see that the trade doesn't make sense, right? My risk is very defined. So it's showing us where that ideal trade location is, and it's giving us clues in real-time order flow confirmation. Also very important. What this all lines up to show us is the sweet spot. All right, so it helps to point out that sweet spot to us and literally show us what direction to trade and where and when to trade, and that's where we have the odds stacked in our favor, plain and simple. Right? What I want to do here for a couple minutes is I'm going to go to some real-time charts here to point out a couple things, and then what we'll do is go back to the slides. Tomorrow we'll be all on the real-time charts, guys. I'm at home in the real-time charts. I don't really like using slides, but sometimes it's easier to use slides to explain things. Everything's nice and organized. But this is what our basic order flow dashboard looks like for any of the markets that we trade. And all I did when I created this dashboard ultimately was take what I found to be the most important and relevant order flow information and organize this info in a logical way that enables us to identify, right? Effectively, we've built our own architecture, right? We've built our own algos that alert us to shifts in the order flow, in the real-time buying and selling pressure, right? They show us the beginning and ends of stop runs, right? They're showing us where real-time support and resistance is in the market and which way the current order flow trend is. The bottom line, it all comes together to make it easier for us to follow what the smart money is doing in the market, right? And if you want to know what really influences price, follow the smart money, right? It all comes down to the smart money and understanding when it comes to the smart money, two main things. Number one, where they want to do business in the market, right? And that equates to ideal trade location for us, right? Because we want to trade where they're trading. And in order to better understand how and where they operate and why they do what they do, this is how we break it down, right? We're thinking in terms of these two things, in terms of where they want to do business and how they get the market into these areas, right? By using stop runs, right? The pursuit of value is a primary source of market movement, right? Stops get the market into areas of value for smart money, right? Thinking in terms of where value is in the market and then thinking in terms of how do they get price into those areas with stop runs. They use stop runs to drive the market either up into or down into areas where they want to conduct business, areas where they want to find liquidity, right? So essentially what we're doing is we're talking about trap traders, right? Every move in the market comes down to traders getting trapped, every swing point, right? On this move here, anybody buying up here becomes trapped. And what happens is we have stop run exhaustion up here. And we're going to get a little bit deeper into this tomorrow. We don't really have a ton of time here today, but I'm just trying to lay the basics here. So again, if this is the first time you're hearing someone talk about the market in these terms, it's very logical, guys, once you're able to process it and think about it. But this is what's driving the market, right? Trap traders every step of the way. So as the market rallies up here into areas where smart money is interested in selling, anybody that buys up here winds up getting trapped because there's no more buying coming in. Not only that, you have the smart money sitting up here with their catcher's mitt, right? So they're absorbing the buying, and they're also coming in and they're aggressively selling, right? So you have stop run exhaustion into smart money participation, and what that turns into is trapped buyers up here, right? So what happens to the trapped buyers up here is they start to come in as sellers, right? Now their selling starts to bring in other sellers. And what happens down here is as the market gets into the next area where the smart money is interested in coming in and conducting business, right, an area that they're identifying as value down here, anybody who sells down here, right, they see the selling coming in, price is moving down, they think it's a good idea to be a seller. Now, anybody that sells down here winds up getting trapped, and it's the same process, right? Stop run exhaustion, there's no more selling coming in, right? Smart money isn't selling, right? Unless news is coming out or something's changed in the market. This is an area that they're interested in buying, right? They're buying to buy back longs from up here, and they're buying down here to get long, right? So now anybody that sells down here winds up getting trapped. The momentum that was here, this from the selling coming in, there's no more selling coming in. And now what happens is anybody that's sold down here at this low winds up having to come back in as a buyer. And it's the same process over and over and over again and on every swing point, right? So now taking a step back here for a second and thinking in terms of value, and value for smart money traders equates to ideal trade location for us, right? Because if we could do a good job of identifying where we think the smart money should be, in other words, if we do a good job of identifying these areas of value in the market real time, right? And again, we're talking about wholesale value below the market, we're talking about retail value above the market. If we could do a good job of identifying these areas in the market, then these areas should be inflection points where we would expect a few things to happen, right? So let me give you a little bit of a better visual on this, right? These components that are happening at every swing point, right? We call this the intersection of opportunity. And every trade that we get into is going to have these components in it. Stop run exhaustion is the first thing that we're going to see, right? Stop run exhaustion meaning the move that is getting powered here to the upside is getting fueled from buy stops predominantly, right? And then other retail traders think it's a good idea to get long up here, but the move itself started from buy stops getting hit, right? And all of a sudden, all those buy stops, they're done. It's like a water spigot getting turned off. It's exhaustion. There's no more buy stops coming in. This is happening into smart money participation. Right? Smart money traders that are sitting up here, again, they're sitting up here with their catcher's mitt, so they're absorbing all the buying that's coming in. And not only are they absorbing the buying by sitting on the offer price, they're also coming in and they're aggressively selling. Right? Now, there's a few things on the screen that are telling us that, but you just come to understand because, again, it all starts with the logic. It starts to make logical sense, and then you start to see this stuff play out over and over again, and now you start to understand, hey, that's why the market turned around up here. It wasn't because there was a fib number here or a trend line or because my MACD showed me this or that. It has nothing to do with that stuff. It has to do with stop run exhaustion into smart money participation, absorbing all the buying here, right, and coming in and aggressively selling. And what happens is that turns into trap traders, right? All this stuff works together, right? It all comes together to form these swing points in the market, right? So now trap traders up here, specifically trap buyers, start to come in as sellers, right? They start to get nervous. They look behind their shoulder to see where the rest of the cavalry is, right? Where's the rest of the buyers? Hey, there's no more buyers coming in here now, right? Now they could start to look at other things. Maybe the cash market starts to sell off. We could start to see selling coming into the order flow here. We're going to get into what the tools are showing us here in a second, but I'm just trying to lay the foundation here, right? So trap traders, trap buyers up here, and what does that turn into? Another stop run in the opposite direction. And then it's the same process over and over and over again, right? So when you have this stop run cycle, it's what we call a stop run over cycle, and you're always going to see these components in the market, right? So remember, we're thinking in terms of where do they want to get the market, the smart money traders, and how do they get the market either up into areas where they want to sell or down into areas where they want to buy, right? They're using stop runs. Stop runs are occurring in the market one after another all day long, every day. And what we're doing essentially, especially when we want to trade with the order flow trend, is we're using the smaller machine-driven stop runs that come in against the main trend to align ourselves with the bigger stop runs in the direction of the main order flow trend. There's really no need to complicate it. There's really a very simple elegance to this, guys. But in order to get in tune with it, you got to understand the basics, right? The basic foundational concepts. So I want you to start to think in terms of stop runs, right? The market is just a series of stop runs. Understand how the smart money and the machines and the HFTs. I see there was a question before about what is HFT, and Raleigh was kind enough to answer it. High frequency trading programs, right? The computers and the markets today, guys. You know, again, I don't want you to get too caught up with the HFTs. Just understand and be aware that they're there, right? And some of these markets that we trade, I don't care if we're talking about futures, I don't care if we're talking about equities, currencies, they're all over the board. And some of these markets, they're conducting up to 80% of the volume on any given day is going to be HFT, computerized trading programs, right? In some markets, some of these bigger HFT firms can be conducting 20% of the daily volume themselves, right? So that's a lot of buying and selling power coming in. So it's important to understand what they're doing to manipulate traders into doing the wrong thing at the wrong time. And it all ties into them running stops from one end of the range to the other. Right? In fact, some days it's funny. I mean, you know, listen, we're on the tail end of a pretty strong rally the last 3 days. What are we up, like 90 points, almost 100 points in Sunday night in the S&Ps. But on the vast majority of days, you come in the morning and the market is opening up, and we have the cash market actually opening up here in about a minute. And the market is opening up on most days not too far away from the previous day's settlement. Right? And meanwhile, throughout the day, the market might go 5-10 points below yesterday's settlement. It might go 5-10 points above, and then it winds up closing almost in the same spot. So what happened during the course of the day besides stops getting run? Nothing. You know, if there's no outside news in most of these markets, you know, different story. If something's affecting the market, there's an outside influence in news, and the market can get into trend mode. And trend mode is nothing more than just hitting stops on higher time frames, right? But in most cases, most days, the market is going a little bit above, a little bit below yesterday's settlement and kind of settling in almost the same spot. And you say, hey, what happened here today? Nothing besides stops getting it, right? So it makes sense for you to get in tune with what's going on with these stop runs, right? So in order to get a clear idea of how this works, we need to think about how the market moves, what's causing price to move. So let's break this down again. And again, hopefully for some people, this would be a little elementary, but for others, it's important that we get everybody on the same page, right? And it's probably a different perspective than what you're used to hearing. Every upward or downward swing in the market, whether it amounts to you know, just a few ticks, all these little stop runs here, right? Every little move in the markets, trapped sellers here, boom, these guys get trapped, they buy them back, their stops get hit, trapped buyers up here. Anybody that buys up here, boom, they're trapped. What happens? They start to come in as sellers. Other people think it's a good idea to be a seller. Now they come in down here. I could do this over and over and over again and show you every swing point in the market is about trapped traders and stop runs. And I don't care if the market's moving just a few ticks, a few points, if it's moving dozens of points. This is just stops getting hit on higher time frames. It's the same idea, right? Every movement in the market, every fluctuation in price is caused by traders getting trapped and their stops getting hit, right? Every upward or downward swing in the market, it consists of numerous buying and selling waves coming in, right, into the order flow, buyers and sellers coming into the market. And these waves of buying and selling, they have a certain duration, right? They're only going to run as long as they can attract the following. Right? Remember before when we talked about fuel powering the engine, the gasoline? This is the gasoline powering these moves, right? These stops getting hit. When the stops get exhausted in a certain direction, right, the market moves up here just as long as they can find buy stops. And when the market hits the last of the buy stops, there's no more buy stops up here at this point. Smart money sitting here absorbing the buying and coming in and selling. What happens is now the imbalance gets created in the opposite direction. Now it's all about sellers. It's like a tug of war going back and forth between buying and selling. That's what's creating these waves in the market. But it's important to understand it's like the spigot getting turned off, right? You have a lot of buying coming in, buying coming in, buying coming in, all of a sudden, boom, the last strip of buying is coming in and there's no more buying coming in. And now this move is exhausted, right? Our edge comes from understanding these order flow dynamics that are created essentially from stop runs. Right? It's a never-ending succession of all these little routes in the market, if you will. Right? As traders get impatient, right? They get trapped, their stops get hit, and they're forced to take a loss. Our edge is in our discipline, our patient response to someone else's impatience, right? Our patient response to someone else's urgency. Right? We're sitting here like a tiger in the woods crouching and waiting for the prey, right? What we mean by impatience is the market moving higher and someone thinking, price is moving higher. It has to continue moving higher. I can't stand it anymore. I don't want to miss out. Right? This thing is going to continue to shoot higher. I want to get in. Instead of waiting for a good spot to get long, I'm getting in long right here. And what happens is as soon as they buy, there's no more buying coming. Right? So again, it's this whole thing that we call the market, guys. This screen that we're watching here. It's like studying the science of human action. It's a process in the market. And we're waiting to take advantage of the imbalance, the distortion in the order flow created by stops getting hit, right? You got to think about this and process it in terms of, the outside market, and we're talking about retail traders. It's very easy for smart money traders to fool them because of their inaccurate perceptions about the market, because they have really no idea about where value is in the market. They're not thinking in terms of where they should buy and sell in terms of value, right? Meanwhile, every day in your life, and pretty much probably every part of your life, when you buy and sell things, you're thinking in terms of value, right? If you're buying a house, big ticket item, you're going to get an appraisal so you don't overpay for the house, right? If you're selling a house, you're going to get a realtor to tell you what the house is worth so you don't sell it too cheap, right? If you're going to buy a car, before you walk into the showroom, you're going to do research on the internet so you don't overpay for the car. You're not going to walk in and pay sticker price, right? If you go to the supermarket and they're charging $20 for a jar of peanut butter, you're going to be like, hey, wait a minute, I could walk down the block to Target and get peanut butter for $5 a jar. Why am I going to pay you $20 a jar, right? But for some reason, when it comes to the market, for most traders, thinking in terms of value goes out the window. They're not thinking in those terms. Right? They don't mind paying up. They don't mind paying sticker price for something that they're probably not going to be able to turn around and sell at a higher price. They're going to wind up getting stuck. Right? This is what drives the market, guys, stop lines. The smart money, the market makers running the majority of all the stops on the other traders. They feed on the stops. Right? So by understanding these basics, you start to understand where the smart money wants to do business in the market, right? Where value is, and then you start to understand how they're getting price into these areas. Before you know it, you're able to identify these areas before price actually gets there. And then you start to understand what you want to see when price does get into these areas in order to take a trade, right? Once price gets there, right? So let's talk about the 3 steps now that we use to align ourselves with the smart money the best that we can. And we'll take a look at the order flow tools specifically here and what they're telling us. There's a lot of good information here. Right? All I did was just lay the basics here, but we have tools on our screen that we've built that kind of help us read this story. Right, so we'll take a look at the order flow tools that we built in order to better organize the order flow information that the market's giving us. Right? Now, just looking back on the questions here, D, please explain the meaning of the range charts. Sure. What we're looking at here and the way that we have our charts organized, and any time that I put the marker on, guys, it freezes the real-time action, so don't become alarmed here. It's a real-time chart here, but as soon as I put the marker on, it freezes the action. But what we're looking at here is what we call a top-down, bottom-up view of the market, right? We're using the higher time frames here to help us form our bias on the market, and we're using this 2 smaller time frames here to help us with identifying trade location, where we want to get into the market, and also to give us that real-time confirmation, the clues that we're looking for that are going to help us with our timing and that are going to help us manage our risk when we get into a trade, right? I hate to think in terms of mechanizing the market because it's very hard to do so. There's very little in the market in the way of constants, and it's hard to make things mechanical. But what we've done here is kind of create a really effective framework around the market that makes it, but the way that we manage our risk, it does become somewhat mechanical. And if there's anything mechanical that you want to rely on when it's trading, it's managing your risk. It's the one thing that you want to try to make as constant as you can as your risk. So the range bars here, we have a 2-range chart here. 0.50 is 2 ticks of range in the S&Ps. This is 4 ticks, 4R. This is what's known as, in 2 points of range is 8R to us, right? 8R, 4R, 2R, and please excuse my writing. It looks like a kindergartner's writing here. And this is a 16R, right? So 16 ticks of range in the S&P equals to 4 S&P points. Right? It's a little confusing that it says 4.0. It should say 16R. I think that would be clearer. But it's range bars. And there's no secret to using range bars or tick bars or time-based bars. The reason why I use range bars is they give me a nice, even view of the market, number one. Number two, it creates a cleaner look for me, because if I'm using a time-based bar especially, and the market is just going sideways, what's going to happen is every minute, say I'm using a 1-minute chart, every 1 minute that goes by, I'm still going to get a bar printing even though the market might not move, right? So what I'm doing by creating these range bars is just giving myself a cleaner look at the market, right? It's less noisy in my opinion. That's it. There's nothing magical or mystical about this, guys. Any way that you want to choose to organize what the market's doing in terms of time or how you want to organize these periods on your charts is perfectly okay. But this is the structure that we use. What's the best time frames to use for day trading? Well, these are the time frames that we recommend for the S&Ps for a day trader. And again, it's all relative. You could take these up a notch. If you're more of a swing trader, you could start here with a 4R and make this your 8R and make this your 16 and your 32R, and it gives you a little bit of a bigger view, right? But all this is doing, and think about it, guys, it's just showing us the cycles in the market, right? Because within this bigger stop run cycle to the downside here, you have a lot of little stop runs, right? This run here in the bigger time frame. Look at all these little stop run cycles that you have here that you can't even see in this bigger run, right? Little cycle here, cycle, stop run cycle, trap sellers here, trap buyers here, and then so on and so forth, right? So what this does is allow us to see these cycles in the market. It's kind of like, the market is fractal, meaning the same patterns appear in all these time frames, no matter what time frame you're looking at. It kind of repeats itself, right? The only thing is on the higher time frames, you see the same patterns, but obviously they're going to take a longer time period to play out. Right? So it's kind of like looking at a map of the United States on the East Coast, right? And then zooming down and looking at a map of the East Coast of Florida down here. And then zooming in on a town on the East Coast of Florida, looking at Daytona on the East Coast of Florida, and then looking at a neighborhood in Daytona. You can get, further and further down into that, using Google Maps. It's the same thing. It's fractal. It's the same thing as the market. Same idea. So again, it's very simple and logical when you think about it. And the reason why it's simple is because it's logical. You think in logical terms and things become very simple to understand. Right? So let me give you an example of the 3 steps that we use, and then what we'll do is break these tools down one by one, and then we'll put that link up on the screen tomorrow. And then this way tomorrow we'll have all the basics out of the way. We could spend more time tomorrow looking at the real live market and looking for opportunities and kind of explaining things real time as they play out. So these are the 3 steps that we use. And again, this is the basic information. These 3 steps is the basic 3 steps that we use this dashboard to show us, to help us with in order to find opportunity, right? Step 1 is we're using this information to help us determine our bias, right? In this case, we have our order flow trend tools down here, trend bars, showing us that buyers are in control, right? In fact, you know what I'm going to do? Let me switch this up a little bit, guys. First I'm going to explain the tools. I think that'll make more sense. That's what I should have done. And then we'll go over the 3 steps, right? So the first tool on our dashboard, and probably the heart and soul of our dashboard, are what we call our TT lines. The TT lines are pointing out the inflection points in the market. And by inflection points, again, what we're looking at these areas are where we assume the smart money is going to be. So walls of smart money traders is what these TTs represent. Right? And they're not impenetrable. They're not unbreakable walls. But these are inflection points in the market. These spots represent ideal trade location for us because, and again, we want to have our bias identified first. So it's not like every time the market comes into the TT, we're looking for shorts, or every time it comes in down here, we're looking for longs. We have to have a reason for looking short up here. So the idea is, hey, all right, we're looking for shorts because of X, Y, and Z. This is the area where we're going to look for shorts. We're looking for longs because of this particular context. This is the area that we're going to look for longs, right in here. These TT lines are doing a great job dynamically, real time, so we don't have to do it. Right? They're showing us where these zones in the markets are, these high probabilities areas for trade opportunities. And again, why do we call this ideal trade location? Two main reasons. Number one, because this is where we're going to assume the smart money is going to be. Right? And if we're looking for shorts here because we assume the smart money is going to be here looking for shorts, and all of a sudden the market starts to get into stop run mode, and for us, getting into stop run mode is a full bar in the TT. That's showing us, like right here, they're hitting buy stops. We don't want to be short. Let's just say, I'm going to take this out of context. Let's just say I got short here, boom, full bar in, I'm out right here because they're hitting buy stops. Now, in this particular case, they didn't go too much further, then they came out of stop run mode. Oh, well, I mean, it would be a small losing trade, but that's our job, to manage risk constantly. I'm not going to second guess and think, hey, you know what? The stop run, it's only going to go another few ticks. Let me hold on or let me add into this position. No way. That's what gets you into trouble. Right? We want to do a good job of becoming very mechanical about managing that risk. We could always get back into a trade. Right, here we are. This happens to be the end of the day. We're not really looking for trades as a day trader at 4 o'clock in the afternoon anyway. But 10 minutes, 15 minutes later, the market's back up in this area, giving us another opportunity to get short, basically in the same spot. Right? But these inflection points are areas in the market where the smart money considers to be value. So if they step out of the way and they allow buy stops start to get hit above here, shorts don't make sense anymore. It becomes pretty clear to us, right? So ideal trade location because that's where we assume the smart money is going to be, and because we don't have to take a lot of risk in these areas before the trade quickly starts to not make sense. So it's very defined risk, right? So those are the TTs. The TT lines are going to point out where the market's going to react on average, and you'll see this real time tomorrow. I didn't just cut out any specific slice of market activity here. I could do this on any random slice of market activity, and you'll see that the market reacts at these TT lines on average 73% of the time. And by reaction, we mean gives us a full bar away before it gives us a TT. So again, just on a very basic level, you could start to see how that could show us where ideal trade location is in the market. If you know ahead of time where the market has a very high probability of reacting, and you have a certain bias of trading in that direction, that's good information to have, right? So those are the TT lines. I'm going to zoom through these next couple tools here so I can show you these 3 steps. The second tool we have are the OA bars. The OA bars, order flow acceptance bars. They're basically showing us who's in control, buyers or sellers, by the color, and when is that control shifting. Very important information. And we're going to show you how all this comes together in just a few minutes. This number you see up here is what we call a delta force score. The delta force score is giving us a real-time score on how good of a job the market's doing of either when it's heading higher, how good of a job is it doing of finding buyers, or when it's moving lower, how good of a job is it doing of finding sellers. Right? So if we're looking for shorts along here at the upper TT, we want to see a lower delta force score, right? Because that's showing us that the market's not doing as good of a job here of finding buyers and buy stops as it was doing over here. Whereas over here, if I was looking for shorts over here, I wouldn't be as motivated here to take a short because this score here is higher than it is over here. So it's telling me, hey, you know what? They're doing a really good job of finding buyers. Now, yeah, they could turn these buyers into trapped buyers, and they could just absorb all the buying and come in and start to pound the sell side. But the confirmation just isn't there to take a trade. Right? So the delta force score is it's a real-time rating, a real-time score, if you will, showing us how good of a job the market's doing real time. The order flow trend tool down here is showing us who's in control in the higher time frame, buyers or sellers. And that's when we want to trade with the trend. And we'll go into this deeper tomorrow. We have two types of main trade classifications. We could look to trade counter trend, right? Especially if the market is in a range. Be a buyer down here, we could look to be a seller down here until they break out of the range. In other cases, when the market is trending hard and hitting these higher time frame sell stops, for instance, we don't want to look to be a buyer against that. We don't want to step in front of a runaway freight train, right? So in this situation, we're only going to look to trade with the higher time frame stop, right? So the order flow trend tool is going to help us in that situation, right? If we don't want to trade against what the trend is on the higher time frame, this is going to show us what that direction is. So in this case, it's sellers in control. So we'd be looking for spots to be a seller on upticks. Tilt, very important tool. Tilt is red triangle that forms at highs, or the green triangle that forms at lows. Specifically shows us when the smart money is becoming in and becoming very aggressive in a certain area. All right, so in this situation, we're assuming the smart money is going to be here with their catcher's mitt absorbing the selling. Off over here is telling us not only are they absorbing the selling, they're coming in and they're aggressively buying. All right, so again, I'm kind of throwing a lot of information at you here with what these tools are showing us, and I'm just kind of scraping the surface here, but hopefully you could start to understand the synergy of how these things can work together, where if you have a bias to trade to the sell side here, for instance, let's look up here because this is a pretty good situation, right? If you're looking to be a seller, right, red, nothing but red, telling us, hey, it's been nothing but sellers in control the last few hours, right? So instead of stepping in front of that, because they're doing a pretty good job of hitting sell stops here, right? So you don't really want to be a conservative trader, doesn't want to look to step in front of that. There's a time and a place to step in front of what we deem to be a trend, but when they're hitting stops in a very intense way, in a very strong way, with a lot of sell stops coming in, you don't want to be stepping in front of that. You want to try and join it, right? So on the uptick here, what do we have here? Right? We have tilt firing off, right, in an area where it makes sense, right? So we would have already been saying, hey, if we're looking short, because this is red, this is the area that we're looking short. Now, what type of real-time clues can I get up here to confirm that I should pull the trigger on a short, right? Well, look, we have a couple things here. We have a red OA bar. Look, you see the bars were blue and then turning kind of neutral, and then they're starting to turn red. Great thing to see. I mean, that's perfect. That's what we call a pocket aces type of situation. In fact, we got the same thing up here too. We have a lower delta force score, right? Look at the 0.8 here compared to the 1.6 here, right? So the market's doing a good job here of finding buyers. Comes up here and it's like they're running out of fuel. They're running out of gas. And you have tilt firing off here, telling us the smart money, not only are they absorbing the buying, they're coming in and they're aggressively selling. In this situation, the probability of seeing a reaction here is very high. It's never 100%, guys. We're never talking in terms of certainties. We can't predict with certainties. You know, who knows? Maybe news comes out here. Maybe some type of huge buy order comes in here at the last second. All of a sudden, smart money steps out of the way and they start to hit buy stops. That could happen. Even if we have a 75% probability up here, guess what? 25% of the time, the opposite thing's going to happen of what we expect to happen, right? So if we expect the market to react here 75 times out of 100, 25 times out of 100, it's not going to. But the good news is we're going to take a small loss on the 25 times, and we have a lot of potential reward that's going to dwarf that loss 75 times out of 100 or 73 times out of 100, right, on average. Right? So those are good probabilities to have, but we can't eradicate losers, guys. There's always going to be trades that turn into losing trades. Losing trades are a part of a day at the office for a professional trader, right? But the good news is, as time goes on, the losses are a lot easier to take when you know that the winners are coming. That's the whole thing. Now, next tool, I'm going to go into the trade delta gauge tomorrow. What I want to do here is get to the my screenshots here so I can show you the 3 steps here real quick, and then we'll call it a session. So step 1 is always going to be determine your bias, right? Again, order flow trend tool is what we're going to use to help us determine our bias. In this situation, it's blue. Telling control we should look to be a buyer in ideal trade location. So our next step is, where is ideal trade location? It's going to be in the area of the TT, right? It's doing us the favor of pointing out where ideal trade location is automatically and dynamically real time, right? So this doesn't change too much. When the market's up here, 10 minutes before it gets over here, we see where the TT is. We know where that ideal trade location is, right? The TT lines are automatically showing us where the entry is going to be. Step 3, when the market gets into this area, we're using real-time order flow confirmation to enter the trade. Right, so here we have a few things firing off real-time to give us that real-time confirmation. We have tilt firing off, right? These green triangles telling us that the smart money, not only are they here with their catcher's mitt, they're also coming in and they're aggressively buying. Very important information, right? We have lower delta force score. All right, look at the delta force score as price moves lower, guys. 1.8, 1.7 right here. Finally, 0.8 on this last downtick. Right, that's telling us as the market's moving lower, the sell pressure is actually diminishing. That's a good thing to see. Right? Final clue, the blue OA bars. Right, look at how the bars turn from red and white bars here to blue. Good real-time confirmation that control is shifting here from sellers. See here, it was all about red, and then you start to get some blue, some white, and now back to blue here, right in an area where longs make sense. Now, this is what we deem to be a pocket aces type of setup, guys. Not every single like this. This is on the scheme of, on the scale of a 1 to 10, this is what we would deem to be a 10. Pocket aces, there's a lot of analogies between poker and trading, right? They're all about speculation. They're all about, matching your wits and experience and skills against other people in the market, just like poker is. It's different than, say, walking into the casino and playing blackjack, where you're playing against the house and the house has the edge, or you're pulling a handle on the slot machine. That's gambling, right? This is speculation. You're looking to line up clues so you could put the odds in your favor. It's all about probabilities when it comes down to it. And again, guys, we just scraped the surface here today. We're going to get into this stuff a lot deeper tomorrow. What sort of profit target and stops are we looking at on a 2-tick range bar, 2-tick profit targets? Great question. Let me get back to the real-time charts here for a second. Now, great question. In terms of profit targets, and again, everything is relative to the context in the market. And context is something that we're going to get into deeper tomorrow. But context, quite simply, is just the background of the market. Right? Most traders are just paying attention to, and I used to be guilty of this, right? I would trade mostly as a day trader on a 1-minute chart, and I would be completely oblivious to what was going on. A 5-minute, a 60-minute was like foreign territory to me, right? Or a daily. I had no idea where we were in the daily scheme of things. Here, we want to keep our eye on the context on the higher time frame for a couple different things. One of the main things is whether or not we're in stop run mode on a higher time frame. If we're not in stop run mode, meaning we're rotational, that means we could look to be a seller. We could look for reasons to be a seller at the top end of the range. We could look to be buyers at the bottom end of the range because we're not hitting these higher time frame stops. We're not stepping in front of the freight train, right? So if that's the case, when we start to think about profit targets, again, it depends. Is the market in stop run mode? Let's just say over here, late yesterday. Yesterday was just about buyers in control, right? The Fed minutes came out. The market was in higher time frame stop run mode to the upside. We did not want to be looking for shorts in that situation. Listen, if you think the market's too high in that situation, fine. If you don't want to be a buyer, fine. You don't have to be a buyer, but you definitely don't want to be a seller and step in front of that. But if you're someone who says, hey, you know what? All I see is buying here. I know the market's high. It's kind of ridiculous in the big scheme of things that all the market is doing is rallying day after day, but this is what it's doing. And you can't fight City Hall. I'm not going to just stick my head in the sand and say, hey, this thing's gone too high. Let me be a seller. I'm going to try and look to join that stop run to the upside. Right? So if I'm getting long at the low end of the 2RTT, right, in a trend to the upside, my profit targets are going to be higher than they would be in a situation where the market's very range bound. And if the market's very range bound, like in here, the market's very range bound, we're not hitting buy stops, my target potential is going to be a lot lower, right? Because I'm going to assume we're going to stay in that range until it breaks out. I'm not going to play for the breakout. It's one thing. If it is broken out, if they're hitting the buy stops and I can get long, then I'm going to hold a runner and go for deeper targets. And my targets are always going to be at the next logical level, right? So if the market's very range bound and I get long down here, I might look to take targets up here, will be my final target. Whereas if the market is trending and they're hitting buy stops and I just got a long off and now it just takes off from there, I'm going to, I might take some profit here, but if I'm trading multiple contracts, why not try and hold on to runners for deeper targets, right? So again, it's all relative to what's going on in the market at the time. I hate to just say, hey, I always take this type of target, I always take that type of target, but generally, more often than not, the market's going to be rotational. So more often than not, I'm going to look to book a quicker profit on a portion of the position and then let another portion of the position run and see how much of a stop run I can catch in the opposite direction, if that makes sense. Just going back and trying to catch up with some of these questions. I think I've caught up with most of them. What's the most efficient indicators to use that predict reversals? Well, for us, it's not in terms really of indicators. It's understanding what's going on in the market. But these are the studies that we've built that when these conditions are firing off, it points to a high probability of a reversal coming in the market, right? Exhaustion, because of that process that I lined up before, right? These tools are basically pointing us to stop run exhaustion, right? In an area where it makes sense, right? Into smart money participation. That's going to lead to trapped traders up here, right? In this case, trapped buyers. And when these trapped buyers start to have their stops get hit, they start to need to exit their trades as the market drops from here. They come in as sellers, right? And what does that create? A stop run in the opposite direction. In fact, if we go to real time here, you see how the market reacted in this area, right? You see all the tilt firing off up here? Now, was this a pocket aces type of situation? No, but you could see how the market reacted in the general area of the TT. In fact, it only went 3 ticks beyond the edge of the TT here. And then now we have a stop run back down to the opposite end of the range here. All right, so again, we're going to have a much better opportunity tomorrow to go through this real time. It's, today we're just kind of laying the groundwork. But if what we talked about here today resonated with you guys, I'm sure you're going to find tomorrow pretty captivating as far as watching this stuff real time. And again, I think Yana did a real good job of putting the link in there throughout today's session, but this is the link again, orderflowedge.com/open-room, or email us at support@orderflowedge.com. That's it. I think if I missed any questions, I don't think, I don't know if I scrolled all the way back. If I missed any questions, I apologize. Don't hesitate to email us. Raleigh and Yana, everybody here, thank you for your time. Thank you for inviting us. It's been a pleasure to be here today.